Welcome to the Snowbird's Expat Radio Podcast, powered by the Snowbird US Day Tracker app. I'm your host, Gerry Scott, and my goal is to give you answers to your cross-border questions, to ease the stress of a cross-border move or extended trip, and to keep you up to date on all you need to know with cross-border rules and regulations. Now let's get on with the show. Well, welcome to the Snowbirds Expat Radio Podcast. We have one of our favorite guests, as Toronto Mike likes to say, our producer. I'm getting sick of it because he's saying that to everybody to kind of build up their confidence. I believe that's what it's all about, Robert. He's just trying to make people feel good. Because when you're in the cold in the East, all you can do is be nice to people. There's nothing.
Well, it made my day.
It sure did. Well,
just that boost of
yeah, well,
confidence.
today is going to be very interesting. This is a topic, Robert and I were talking last week, and we were kind of comparing notes on how many calls he's getting on this subject and how many calls I'm getting and how many emails. And, you know, we always said that the idea of this podcast was to connect people with their concerns and questions and how they need to implement these strategies with the right professional. So today we got the right professional when it comes to if you're thinking about selling your home in the States, for whatever reason it may be, and we'll go into this, and we'll try not to get too political. We got to tone Rob down every once in a while because he says, I never voted for the guy. But there are concerns in the States, may it be geopolitical risk, may it be a demographic issue forcing people. Kids don't want the home in Maui. They don't want the home in Sarasota, Florida. They want the loot. They want the money. And and we've done a couple reels on this, and one of the surprises we can't mention it yet because the book isn't out yet. Oops. But we have written about this subject, about individuals selling their properties in the States. And it's not one of those things you just all of a sudden call up a realtor and say, put the sign up. You need to talk to someone like Robert before you go through that process. So, Robert, let's get going. Thank you again for your time. I know you're a busy man, but let's jump right into it. People want to sell their homes in the States, and what should they do first, other than give you a call?
Well, I think the very first thing is contact a realtor in the jurisdiction where the house is located, whether it's Hawaii, California, Arizona. You need to discover how much the house, one, is worth, and two, how the market is reacting, right? Hard to say how home sales are. I mean, I'm sure it's sluggish in areas like Florida, Arizona. Doesn't mean you can't sell. The second thing is you need to determine what your capital gain is going to be, right? For U.S. purposes, again, it's much simpler, I think, than figuring out for Canadian tax purposes. Everything, for one thing, is stated in U.S. dollars. You know how much you bought it for on the date you purchased it years before. In many instances, it's in U.S. dollars. You're going to know what your proceeds are, and you'll know what your cost of sale is. You can also include major renovation expenditures, new roof, inside remodeling, new kitchen, new bathrooms. Those expenses can be added to the basis, which ultimately reduces your net capital gain.
Okay. Now, when you say you're getting a lot of calls, walk me through these people that are calling you. Because like I say, we're getting emails where, this is a subject that I think is not just political, but it really comes down to the kids wanting mom and dad to do something before they die. So
that's exactly it. Yeah. We have a lot of clients that, or just folks that were referred to us from other accountants. They're looking at selling before they die. It's a much simpler process. They sell it. They're going to be paying tax to the United States. They're going to be paying tax to Canada. The tax they pay federally and to any, the state, if an income tax applies, like Arizona, California, Hawaii, they'll receive a foreign tax credit as an offset against the amount they ultimately owe the CRA, right? So in that instance, they won't be double taxed, right? But I think right now the hard thing to do is to sell in, a fairly timely manner. I mean, a lot of houses in Arizona, California, Hawaii, they're simply not selling. They're not selling as fast, and inventory is building up. So we all know what happens when inventory builds up. Prices tend to come down. So I think, in my opinion, if you're going to be selling, might be a good opportunity now, since we're moving into spring. A lot of people buy in springtime, early summer, etc. in these areas, and realize the gains while you still have them. Right?
Now, before,
I'm not saying the real estate market's going to implode,
no, I think you already did
but
that.
the
You
real
already
estate,
said that.
yeah, they do follow peaks and valleys,
Yes.
right? So we tend to, I think we're definitely at a peak right now.
Well,
So
let's before we get into that process of selling your home, and there's other taxes that are withheld until a clearing certificate is issued. What did it used to look like when my mom and dad had that beautiful home in Maui, and I just put my hand out and said, "I'll take it." What does that process look like? What it looked like then, and what did we have to go through compared to what it's looking like now, where the kids are no longer putting their hands up and saying, "Sell and give me the
mhm.
loot."
Well, I mean, if they sell again, they need to calculate their tax. They're going to be filing. More importantly, they need to have a U.S. taxpayer ID. It's called an individual tax identification number. You can't just apply by filling out a W-7 and turning it into the IRS. There has to be a basis, right? One of the bases is you're selling a piece of U.S. real estate. So, if it's jointly owned, right? Spouses, each spouse has to file and has to obtain an ITIN. There's no such thing as a jointly filed 1040-NR, right? For non-residents, Canadian owners. Basically follows the same pattern as in Canada, where everyone files an individual return. And when it comes time to claiming foreign tax credits with the CRA, it's actually, it aligns quite well, right? 50% is going to be reported, calculated, and tax paid for the husband, 50% for the spouse, vice versa. They align with the Canadian tax returns. CRA ultimately is going to be asking for verification of proof that those taxes were paid, IRS transcript, state of Hawaii or California transcripts, and a copy of the tax returns. Those all need to align and be properly reported on the T1. Then the CRA will grant the credit, right, as an offset. Years ago, hasn't really changed much, but the big difference is for folks that waited until their parents died owning these properties, it's just more burdensome. It requires a non-resident U.S. estate and gift tax return. The value of U.S. situs property, if it's $60,000 or more, it's required. You have to file it. About a year later, you're going to be requesting the clearance, the estate clearance certificate. All said and done, it could take 2 to 3 years to get that clearance certificate, which will then allow you to sell the property, right? If the parents sell while living, the only thing they're subject to is FIRPTA, Foreign Investment in Real Property Tax Act, which is between 10 to 15% of the gross sales price, and any state non-resident withholding requirements that there are, right? California has them, Hawaii has them, Arizona does not. Washington State doesn't have a system of income tax, so nothing to worry. There's several states that don't have income tax. Unfortunately, many of them are cold weather states or blazing hot, like Texas or Nevada.
We'll be right back.
Thinking about becoming a Canadian citizen? If you're a U.S. resident living in Canada on a work permit, permanent resident status, or planning your path to citizenship, you already know the rule: 1,095 days of physical presence in 5 years. Meet the Canada Physical Presence Tracker, a simple, reliable mobile app that helps you log your days in Canada, track multi-year stays, and monitor your progress towards citizenship right from your phone. No spreadsheets, no guesswork, just clear tracking so you can stay on track. Download Canada Physical Presence Tracker from the App Store or tap the link in the show description. And if becoming a Canadian citizen is part of your plan, you're already in the right place. Snowbird's Expat Radio features conversations with top immigration lawyers and cross-border experts to help you understand the rules before they become a problem. Build your path to citizenship with confidence.
Now, FIRPTA is a federal tax, and what you're saying is maybe some of the states might have additional tax. Hawaii would be
Oh, they do.
15 plus 7, I believe it is.
Yeah, thereabouts. Yeah, California.
Okay.
Escrow companies always perform that task.
Now, so my question is that when you mention it's probably a good time to sell the property, real estate, yes, let's get it all nicely cleaned up and shows well in the summertime. But does that also give you that 5 or 6 month runway? Would it make sense from a tax perspective as well, too, to give you a little bit of time to get everything lined up?
Absolutely. Yep. A lot of my clients, they have this in mind several years. They have their paperwork in order. They know what they need to do. They contact realtors, usually referrals. Hawaii, California, Florida tend to be the hotbeds of sales. And they sell. And then they contact us, inquiring about an ITIN, the process, what they expect their tax rate to be, etc. So it's typically a smooth process. Now, one thing I do notice, a lot of escrow companies in the United States, they get confused by foreign nationals selling property, right? If you are joint owners, husband and wife, under U.S. rules, you can file a joint income tax return. American citizens, married, you can file jointly. For non-resident Canadians who sell, there is no such thing as a joint federal income tax return. Escrow companies get confused and issue many times only one 8288A withholding slip with both owners' names on them, using only one ITIN or social security number, right? That presents problems. Only one spouse has the credit. The other spouse has a rather large payload with no credit, and you can't split it. So what we ask the client to do in that instance is contact the escrow company, explain they each have to file a 1040-NR. Only 50% of the net gain is going to be subject to tax, and as a result, calculate and withhold for each at a 50% rate.
This is why we discussed that. This is a cross-border planning event, and the realtor is going to be excited to get a lead, an opportunity to make some money and put that sign in the front yard, and who knows, all of a sudden, bang, it's sold. Maybe you get fortunate, but I also find that the realtors, as charming, as wonderful people as they are, as soon as someone starts talking about buying another property somewhere else, now that is it a 1031? Is it the 1030?
It
I know it
fails for
does.
Canadians.
Let's touch base about that, because I hear it all the time. Realtors suggesting this for Canadians, and tell us why it doesn't work.
Well, there's no provision in the Canada Tax Act. Yeah, it just doesn't exist, and it's going to be a taxable event for a Canadian tax res. Simple as that.
And I guess the other thing too is, yes, you got that taxable event, but then at the same time too, you've also got FIRPTA that's going to basically tie up on a $3 million place. It could tie up, if it's 15% Hawaii plus.
Yeah.
I mean, you're tying up $600,000 in you're going to have to try and get back.
Well, there's a mechanism. You can file what's called an 8288B. You can file that standalone along with the W-7 if you don't have an I-10. And what you're doing there is you're seeking either a elimination or a great reduction in the amount that's going to be withheld. Problem, IRS processing times. It could take you 1.5 years to get that. Plus, the escrow company is going to have to hang on to your money in an interest-bearing account until they hear back from the IRS. So in my view, it's probably just the safest bet to sell it, have the IRS hang on to it. Make sure at least your withholding slips are properly constructed and filed, and then file as early as possible, when the tax season starts, so that you can get your refund. Now, here's the other issue. The IRS is literally in a state of disorganization, and I wouldn't say it's imploding, but many people are quitting. They're leaving. They don't want to work for it. And in my opinion, it's kind of falling apart. So don't expect your refunds anytime soon. Used to take maybe 6 to 8 weeks. Now it's taken upwards of a year, right? So that's the other wrinkle. It's the IRS,
Now,
right?
is there also a threshold? So let's say, for example, you got that little trailer down in Mesa, and it's worth like 250 grand. Is there thresholds depending on state?
Here is 300,000 if the selling price is 300,000 or less. FIRPTA does not apply, or that's an exclusion. Big problem is escrow companies. Oftentimes they don't want to. They're just going to default on what's safest from their perspective, and regardless of price, they're just going to many times they'll withhold and then remit to the IRS and just say, hey, look, we're not going to entertain zero withholding. We're just going to withhold and then remit, and you can claim the refund upon filing. That's what I'm
Okay,
seeing.
how many calls do you get? The person's on the other line and says, "Oh, by the way, I just sold my place a year ago. I had no idea this, and this." How hard is that to fix?
Well, if they sold, it's not fair. As long as they sold it, say they sold it in 2025. Tax season right now is 2025, right?
Yeah.
That's what we're building. So they basically need to provide the sales statement. It's called a HUD, Housing and Urban Development. It just provides the debits and the credits between the buyer and the seller. We would also need the original purchase documents so we can determine what the cost basis, and then an itemized list of any large capital expenditures, as I alluded to earlier, such as new kitchens, roofs, HVAC systems, all of that. We can add that into the basis. Different rules do apply if these homes were rented in the past, right? So, then we're dealing with recapture issues and so on and so forth. But pretty much it follows the same trajectory in either
Well, let's
case.
believe that some Canadians are offside. They rent it out to friends and all these other family members. They've never ever had an ITIN number. The realtor basically put the sign on the yard, and within 2 weeks it was sold. And now you're involved. You say it's okay because we're still dealing with 2025 tax season. But what happens if you don't have a ITIN number, so you can help file that U.S. 1040?
Well, that's the problem, because when they do the withholding on the 8288A slip, which documents the sale price, the date, the amount realized, and the amount that's subject to either a 10 or a 15% withhold, there's no ITIN because they don't have one. But they still process it, which is in accordance with the rules. It goes to the IRS. Taxpayers will receive a letter from the IRS saying, hey, we notice you don't have an ITIN. Make application as soon as you can. Unfortunately, as soon as they can is the same time when they file their 1040NR, their personal individual income tax return. Typically takes the IRS about 3 to 4 months to process the ITIN. Then the tax return is processed, and that can take upwards of a year, because it almost always takes my intervention with the IRS to call and to ensure that they apply the credit, right, the FIRPTA withholding, to the newly issued ITIN. For whatever reason, the IRS has real issues when it comes to that seemingly simple task.
Now, on the calls that you're receiving, if you had to say, how many of them are political, where people are really concerned about the uncertainty?
Large number. I would say a vast majority, 80, 90%, right? They've enjoyed their property, but they're scared off. They don't want to fly there. They don't want to drive there. They just don't, at the moment, I'm pretty sure this will change. They don't want to go into the United States. And so as a result, they think, hey, I no longer need this property. Let's sell it. Let's take the cash and I'll go to Europe. I'll go to Mexico, right? The days of owning a property in the United States in their minds is over, right? And it's purely political, right? I oftentimes hear, the comment about Trump's comment about Canada being the 51st state, the prime minister being the governor, those sorts of things, right? The insanity of these tariffs, impact on the Canadian economy, just the overall disrespect, I guess that's being shown.
We can.
And that in their mind triggers their desire to sell.
We'll be right back.
If you enjoy this podcast, my new book is your next step. It's written for Canadian snowbirds who want to better understand the cross-border rules that can impact their time in the U.S., from taxes and healthcare to travel and long-term planning. Visit www.snowbirdsheadingsouth.com to learn more about the book.
We can only speak for Maui because of our relationship with the Hawaiian people and our enjoyment. I mean, I'm not staying away for political reasons, and it's a beautiful democratic
but Hawaii
state.
is much different
Yeah.
than India.
And I'm not going to say, I don't want to say I'm a
Hawaii.
Republican or Democrat. I'm right down the middle of the road, and people remind me that if you're standing in the middle of the road, you're going to get run over. But we talked to some of these tour companies, and boy, they're getting hurt. I mean, their businesses is off. During peak season at Christmas time, they're off 65%. People are packing up and leaving. I mean, that's how bad it is. So where are they going? I have no idea. They're looking. I've got the welcome mat for Canada. Come on up to Canada. We've got rainbows and unicorns. I mean, it's a beautiful place. And you're a dual citizen. You're American at one time, and obviously moved up here.
I am.
So we know that a lot of it is political uncertainty, which, boy, and we talked before we went on air, there's other events going on right now, which we're just shaking our head, not understanding what the plan is or what's going on. Are you seeing a lot of pressure on kids saying that?
Or even the future repercussions of it, right?
Yeah. Are you seeing pressure? Yeah. Mom and dad are saying the kids are just wearing us down. We got to sell. Because we're getting those calls.
I see that as well. You bet. Yeah, you bet. Your mom and dad are in their 80s. They still have the property. The kids just don't want the hassle of having to deal with the property, no less in the United States. And so they put some pressure on their parents to sell, right?
Well, let's use a real generic case here. Person in Florida paid $250,000 for the. No, I'm going to say Arizona. I'm going to say they bought it during the financial crisis of 2007. There were some great bargains out then. And Canadian dollar was at par, and now it's appreciated to about 136 and change. So they paid $300,000 for that place, U.S. It's now worth $1 million U.S. So we wanted to talk about the hidden tax shock to Canadians. So what do you think on a situation like that? Let's say that the cost base is $300,000 US.
Vancouver.
And that would have been at par with the Canadian dollar in 2007. And what is today? So that's 2000. What is
137?
Sorry? Yeah.
I think it's 137
yeah,
today.
Exactly. So they sold the place. So now that's going to be roughly 300. So it's almost $1 million gain, because now we're looking at over $1.3 million when you convert it back to Canadian dollars.
Well, yeah, for sure. Yep. Keep in mind, you need to use the rate when you bought it, and you need to use the rate when you sell it, right? And if there are any improvements, then you need to use the rate when you incurred those improvement costs, right? So we have several different rates between the U.S. and Canadian dollar that we're dealing with. So right now, because the Canadian dollar is so weak, it makes the proceeds in Canadian much higher, right? As opposed to, I mean, if it were par and you sold it for 700,000, it's 700,000. But if it's now say 137 and you sell it for 700,000 US, then your Canadian gain's much higher, right? And you're going to be paying more. Right?
So let's walk away saying that it works out to be that the gain is $1 million when we convert it back to Canadian dollars On the U.S. side, that would be roughly $700,000. Um, so
Hmm.
what do you?
Seven,
Yeah, so let's say $750,000. So capital gains, it's a long-term capital gain. So
15%.
okay,
Federally, and Arizona would be 4.
okay,
Really depends on how much income. And again, keep in mind, as a Canadian tax resident, resident of Canada, filing as a non-resident of the United States, the federal and the state tax that's paid, that will offset the amount that's due the CRA. And keep in mind also, capital gains in Canada, only 50% are going to be subject to the capital, to a capital tax in Canada at half of the marginal rate, right? So once you factor in the foreign tax credit, there's going to be a little bit extra to pay to Canada, but not a whole lot, right? In my view, it's still a good deal. It's better to have a gain than a loss, in
yeah.
my view.
So is it safe to assume that on a roughly $1 million, and I know this is really a generic question, but if you said it was $1 million Canadian gain, is it safe to assume that they're going to be paying $200,000 and $300,000 in taxes on the Canadian side?
Well, 500,000 would be to a max rate, I think, in BC of about, what is it, 27%? So it'd be a big
Yeah,
gain, right? But then on the US side, you'd be looking at, $100,000
yeah,
credit, right? 15% of
yeah.
750, say.
So that foreign
So
tax credit would then go on the Canadian side, which would offset any kind of tax thing.
offset, you bet. It's not going to completely offset because the rate in Canada is still going to be a bit higher, but it's certainly going to help.
So tax shocks, I mean, obviously you've got all these numbers. Is it really, and this is what if I was selling my place, the first thing I would do is I would reach out and I'd give you a call, uh, and say,
Mhm.
okay, before I get that realtor to put that big, all that enthusiastic sign planting on my front yard, um, talk to you first, and you guys kind of crunch all the numbers, and so there is no hidden tax shock, making sure that an ITIN is in place, and
Mhm.
the FIRPTA, making sure that they're familiar with that. Um,
Mhm.
so once again, full transparency takes away the shock factor.
Oh yeah, for sure. And I would also encourage them to contact their Canadian accountant,
Yeah.
right? Ultimately, they're going to be paying Canada as a result of this sale as well.
Okay.
I wouldn't be familiar with their, even their marginal rate in Canada because I only do the U.S.
Yeah.
portion, which only reports U.S. source income, which in this case it would be U.S. source income from the sale of either a personal use residence or a U.S. rental,
Okay.
right?
Well, you know what?
And they're not taxed on
I
anything
find
else
this,
other than that.
obviously this is the one that you're getting bombarded with calls. We're getting bombarded with calls, emails, and it, like I say, it is motivated by political uncertainty. It's based on demographics because these people are now getting older. They've had the property
Absolutely.
for 20 plus years or early 70s. That's where we're finding these calls are coming from. And parents do want to help out their kids, take some of this
Mhm.
dough because the kids don't want to, they want to travel the world. I mean, I know our kids don't
They,
want to be going back and forth to Maui, especially if they have to pay for it. And here's another factor that we never discussed, and I can only speak for Maui. Property taxes have escalated. We know because
mhm.
of the fire, insurance costs have escalated. Inflation, we hear it might be 3% nationally in the states, maybe a little bump higher. It's got to be getting close to double digits in Hawaii, in Maui.
Oh, absolutely. Everything's
Yeah,
imported.
so those three things are
Every,
just causing people to say we can't afford it.
yeah.
Um, you know,
Even unrest in the Middle East. I mean, that's a major oil market. If the oil doesn't begin flowing again, that's pure inflation pumped right into our economies, right?
well, and
Um,
hopefully the current administration. I won't keep this too political, but last time I checked, we have one of the largest reserves in that little beautiful province of Alberta. So, and the
yeah,
entire infrastructure is
absolutely.
built to maintain this relationship long after the current administration. Hopefully that doesn't last forever.
Hmm.
It could if he becomes a dictator of the United States, if he isn't already. Well, you know what? I got to cut you off there because I can see that you're getting. I can see the steam and the sweat as soon as you started talking about politics. So
Yeah.
we'll move on. But Robert, as always, I appreciate your time. I appreciate the care that you take with our clients, and thank you again for your time.
Oh, anytime. I enjoyed being on these podcasts. Yeah, it's
Okay, well,
wonderful.
you be safe. And last time I checked, QB is on the Vancouver Island, so now we're neighbors. So,
Yes,
and you
that's right.
mentioned you like vino,
Absolutely.
and I'm not much of a drinker, but hey,
Well, we'll have you
yeah, we
guys
look
over.
forward to it. Well, you be safe, and big
Yeah.
hugs to your wife and your staff, and thank you for everything.
Okay, you're welcome. Take care.
Thank you again for listening to the Snowbird Expat Radio Podcast. The best way you can support the podcast is to forward the episode to a friend, and please don't hesitate to like, subscribe, or leave a comment. Now, before you go, let me leave you with one of my favorite quotes. Be kind to all, the world is small.